There is good news and yet more good news for value investors. December 16, 2023. Last night's announcement by the U.S. Federal Reserve heralds a significant shift in global monetary policy. The decision to end the era of rising interest rates carries far-reaching implications that extend beyond the borders of the United States. This momentous event marks the conclusion of a global monetary tightening cycle. Great news for all investors, even income investors who might like high interest rates. For years, investors and financial analysts have closely monitored the actions and pronouncements of the Federal Reserve, as its monetary policy decisions reverberate throughout the global financial landscape. The recent announcement that the Fed is putting an end to its hawkish stance on interest rates signals a turning point in a pickup in tempo for the post-pandemic economic recovery. One of the key takeaways from this announcement is that the global monetary tightening cycle, characterized by central banks raising interest rates to combat inflationary pressures, has reached its zenith. This marks a significant departure from the narrative of recent years, where the specter of rising interest rates loomed large. The shift away from rising interest rates does not necessarily imply an imminent plunge in borrowing costs. Rather, it is a recognition that the era of aggressive interest rate hikes has run its course. While the Fed's decision signals a shift towards a more accommodative monetary stance, it does not mean that interest rates will plummet overnight, but the direction of travel is set. One of the primary reasons for this cautious approach is the lingering issue of inflation. Inflation, which has been a central concern for policymakers, is not expected to subside quickly, because they still need more than creeping inflation to balance the books. While the blame for this sticky inflation will be explained as the result of persistent supply chain disruptions, surging energy prices, and continued high demand for goods and services, that will not be the case. The only thing that makes inflation is increased money supply, and that comes from government policy. And sometimes that policy needs elevated inflation. And here we are. As such, central banks will tread carefully in their efforts to bring interest rates down until fiscal policy is back on track. Now, let's delve into how this development is likely to impact the UK stock market, particularly the FTSE 100 and FTSE 250 indices. The UK stock market is poised to reap the rewards of this pivotal moment in global monetary policy. The positive implications for the UK economy are expected to be preempted by at least a year in UK share prices, so we will see an uplift well before the dark cloud of hard times dissipates. This anticipation reflects the market's inherent ability to look ahead and price in future expectations. As the global monetary tightening cycle comes to an end, the UK market is likely to embark on a sustained rally that could span 3 to 4 years. This rally will be fueled by several factors. Returned economic optimism. The Federal Reserve's shift away from interest rate hikes will boost confidence in the resilience of the US and global economies. This optimism is contagious and is expected to boost investor sentiment worldwide, including in the UK. Business expansion. With borrowing costs expected to start falling, businesses in the UK will have greater access to capital for expansion, innovation, and job creation. This bodes well for corporate profitability and, consequently, stock prices. Dividend growth. UK companies, particularly those in the FTSE 100, are renowned for their dividend-paying prowess. As economic conditions improve and corporate earnings rise, income investors can look forward to a solid and growing stream of dividends, providing a stable source of income. Investor appetite. The prospect of a multi-year bull market in UK stocks is likely to attract international investors looking for attractive returns and bargain basement M&A. This influx of capital will further propel the market's ascent. In conclusion, the Federal Reserve's announcement marks a milestone in global monetary policy, signaling the end of the era of rising interest rates. While interest rates may not decline rapidly due to persistent inflationary pressures, the shift towards a more accommodative stance has far-reaching implications for financial markets. For the UK stock market, this development is poised to usher in a period of sustained growth, with the FTSE 100 and FTSE 250 indices rallying for the next 3 to 4 years. Investors can anticipate not only capital growth but also a reliable stream of dividends, making the UK stock market an attractive destination for income investors. As always, prudent investment strategies and careful stock selection will remain key factors in capitalizing on this new promising market environment.